right, good afternoon and welcome to the Sage Investor webinar. Thank you so much for joining us today. My name is Jin and I am a co-founder of the Sage Investing Group along with my partners Maggie and Lana. The three of us are actually CPAs who also really enjoys real estate investing. So we all decided to quit our jobs and become full-time multifamily syndicators. And we help our investors confidently invest in alternative assets such as multifamily properties. So one of my favorite things about investing in real estate is not just the fact that we are investing and buying and appreciating and cash flowing asset, but I also think the tax benefits are amazing. So to be honest, it was actually one of my main reasons for getting started in real estate investing in the first place. So I wanted you all to kind of know why it's so awesome. And that's why today we've invited somebody who is extremely knowledgeable about this topic. Brian Bigham, he is the Associate Vice President for Madison SPECS, which is a division of the Madison Commercial Real Estate Services. In 2017, he joined the Madison team as the Vice President for Business Development in the Cost Segregation Department. Brian has spoken at well over 65 events in the last 3 years, and it would probably be a lot more if COVID didn't happen.
Fortunately.
Yeah. So he brings a lot of awareness and education on tax-related benefits in all sorts of real estate, specifically commercial real estate. So all three of us, we've attended and enjoyed many of Brian's events and webinars in the past. And he's done pretty much all of our cost segregation studies at all the multifamily properties that we invested in. So we are really excited to have him here today. Welcome, Brian.
Thank you for having me.
Thank you for joining us. We really appreciate your time and we are really excited to hear what you have to say.
Absolutely. Absolutely. So, thank you so much for having me. The idea is, I just enjoy talking about this subject, not because it's, my job, but in all honesty, I loathe paying taxes, and any opportunity, any chance that I can get to not pay taxes legally and assist as many people as possible in not paying taxes, that's where the commercial real estate tax benefits come into play. So that's definitely why I love my job.
Yeah, no, I am so glad we bumped into you and that we know you because you've helped us so much in terms of decreasing those tax liabilities over the past few years. And I am so excited, for our investors to learn, how it's done.
Absolutely. Absolutely. So I've got a little presentation and if you're ready, I'm ready.
Yep, let's go.
All right. So basically the title, Lower Your Tax Burdens by Investing in Real Estate. That is as summarized as you can get. If you are investing in commercial real estate, everybody, you should not have to pay any, if not little, in taxes. That's my fat face on there about 30 pounds ago. So let me go to the next page. A quick overview, kind of what I'll touch on is, what is depreciation and cost segregation, benefits of a cost seg study, bonus depreciation, which is a huge hot topic right now, when you should do it, who you should, who should do it, real estate professional, why is that beneficial? I'll give you some examples on, how it really applies to you and how it applies to multifamily properties. And then just a couple other pieces of information about our company. So overall, like, what is depreciation? It's the definition of it is a reduction in the value of an asset. I always call it wear and tear. And a great example is think of your iPhone. Okay, an iPhone. If I have the original iPhone 3, right, with a cracked screen, the battery lasts all of 10 seconds. I've used it for years and years and years, and I decided today I want to go and trade it in for a brand new iPhone 12, straight up. I just want to say, hey, look, I've got the old iPhone. I want to trade it in for the new iPhone. Do you think they would let you do that straight up with no extra costs? So the idea with that is it's all wear and tear. Over the course of time, physical property depreciates in the life expectancy. So in terms of commercial real estate, you've got two types of categories. The residential side, which the IRS says, well, everything on the property depreciates over 27 and a half years. And then non-residential property, like warehouses, retail, hotel, that kind of thing, depreciates over the course of 39 years. So how do you calculate straight line depreciation, right? You basically take a purchase price minus land and divide it by either 39 or 27 and a half. And let me go to the next screen just to give you a quick example. Okay, just a quick example. $1 million purchase price. Take out land. Land has to be taken out of the equation. If a tornado came and knocked a building off, then the land will still be there. Okay? So you take land out, it is non-depreciable. So that leaves you with what we call a depreciable basis. So 1 million minus 150K equals $850,000 in your depreciable basis. That is what we take on straight line depreciation. You take 850,000 divided by 39 for non-residential. That gives you $21,794 each year, every year for the next 39 years. You do the same thing with the residential, multifamily properties, single family rental houses. You do 27 and a half years. You do 850K divided by 27 and a half, which will be 30,909. So what is cost segregation and why is it beneficial? You're basically doing a breakout of all the components. You're reclassifying all of the physical assets. You're taking all of the pieces little by little, all the detail, all the line items, and you're actually putting them where they're supposed to be, which is vastly accelerating all that depreciation, and it's producing significant non-cash deductions. Now, I'm going to use a bunch of big words like this, and I apologize, but I'm going to try to make it as simple as possible when it comes to giving examples because I'm a big metaphor guy. So whenever I'm talking about reclassifying, what are we reclassifying? Okay. You're taking 5-year category. 5-year property assets is interior stuff like carpeting, appliances, cabinetry, millwork, basically things you find on the inside. Right. And then you take a 15-year property. 15 years like your exterior land improvements, carports, fencing, retaining walls, signage on the outside, gates, all of these things that are on the outside depreciate over the course of 15 years. And then you have a last category, which is what we call 27 and a half year property, which is your structural components, your foundation, your windows, your walls, your roofing. So I'm naming all of these assets because what we're going to do is give you example side by side with cost seg versus straight line depreciation. The red line is straight line depreciation, what I was telling you before. You take your purchase price minus land and you divide it by 27 and a half. That red line, you get the exact same amount each year, every year for the next 28 years. That doesn't make any difference if you purchase a property and you put in significant renovations. If you raise the rents to even what the market is, if you are forcing the appreciation, you're getting more and more income every single day, and it doesn't make any difference to the IRS because we're all pieces of paper to them. It's saying, look, if you're doing straight line depreciation, all of these assets, you're dividing it. This is how much you're getting, and that's it. But with cost segregation, what we're doing is we are putting that 5-year property, 2 years, 1 through 5, 15-year property 1 through 15, 27.5-year property 1 through 27.5. So what that's doing is it's pulling all of that depreciation from the next 30 years and moving it forward. Like, we're not at the end of the term, we're not getting you more depreciation. We're not giving you more um, losses. We're not giving you less losses. What we're doing is we're just simply moving them where they're supposed to be in their life expectancy. And by doing that, you can see the blue, which is cost seg. You're getting the first 5 to 6 years, you're getting massive amounts of additional losses that you can offset pretty much all the income from that one property that we'll talk about later. You could also move to other properties as well. So what are the benefits? I mean, it reduces your tax liability. It increases your cash flow because that's money you do not have to pay the government. It's what we call the time value of money. It's about what can you do with that money now. And it's just something I always try to make sure and reiterate with people. You've got to change your mindsets in this business, guys. It's not about how much money you make. It's not about how much income that you're getting. It's not about making money hand over fist. At the end of the year, it's about how much can you keep, right? And that's why we say the time value of money. It's about how much can you keep now that you can reinvest and continually build up losses. So, and the last thing is about bonus depreciation, which again, such a hot topic. We'll get to that in just a second. I always put this in there. I'm trying not to be involved in politics. I'm not, the donkey or the elephant, the red, blue, green. If you ask me who I voted for in the last election, I'd lie and say like Kanye West or something. Okay, guys. So I just always want to talk about, because this tax depreciation plays such a big role when it comes to whatever new politician or new policy or new proposals out there. So I wanted to put this in. I won't play this right now because it's about 2 minutes long, but I'm sure everybody remembers this. When basically it was the very first time I had so many videos to choose from. This is one of the first times that it was brought up that Donald Trump, former President Donald Trump, big real estate mogul, made his millions and billions in real estate, how he did not pay a dime in federal income tax at all. And it's she very much put that in front of it. And his very first response on this video right here was, well, it's because I'm smart, and because of the laws of massive tax depreciation laws that your government has passed, I take advantage of it. That's it. All right, great. So my thought when I was actually first watching this, when I first got into the real estate tax world was, okay, this billionaire made his money from real estate. He's now the president. He needs to figure out a way to put his money where his mouth is and help the American people. All right. And that's where we come up with the Tax Cuts and Jobs Act of 2017. All right. So everybody needs to remember the magic date, 9/27/17. 9/27/2017. It basically is saying that any property, commercial real estate property, any income producing property purchased after that magic date is eligible for bonus depreciation. Bonus depreciation allows you to take all of those tax losses that are under a 20-year useful life, which is the 5-year property, the 15-year property. You're able to take all of that in year one. And the coolest thing about this is it does not matter when you purchase the property. If you purchase the property on December 31st at 5 p.m. this year, you have it eligible of taking all of that depreciation for 2021. So cool. There are, a couple of caveats, obviously, like you cannot buy and sell the property within a year and use the bonus depreciation. They won't let you do that. Is it, a lot of people ask me, is it beneficial to use for everybody that's involved in the property? Well, it comes down to the point where everybody involved in a syndication gets their own K1s distributed. If you have cost segregation and bonus depreciation done, you actually have the option of which one you want to use. And I can go over that in more detail during the Q&A if you have a question on that. But the key to this is it produces huge non-cash deductions that you can apply to other gains. It doesn't necessarily have to be this property. It could be spread out across a portfolio. So that's where these losses, these passive losses, active losses, everything really comes into play, and you need to identify how you are classified with the IRS. Oh, this is just a quick example of bonus depreciation versus straight line. Again, the red is the straight line depreciation. So year one, you are 10, 20 timesing the amount of losses instead of taking them over the next 5 or 6 years, like that first example I showed you. You are pulling all of those and putting them into year one. Year one. It's insane. Okay. So I actually have a lot of people asking me this question as well. Brian, with the new government in place, and everybody's talking about different types of tax, taking care of the real estate side of the taxes, 1031s, bonus depreciation. What's going to change? So as of right now, I have not seen that bonus depreciation is going to change because it's currently already slated to become phased out starting at the end of 2022. So for instance, what I'm saying is bonus depreciation, the 100% bonus depreciation ends December 31st, 2022. 2023, you're only allowed to take a maximum of 80% bonus depreciation. And then every year it drops 20%, 20%, 20% until 2027, it's gone. No more bonus depreciation. Cost segregation will still be here. It's been around since the 80s. It will always be here, but bonus depreciation starts to phase out and it will be gone by 2027.
So you're saying it's better to start investing now?
Oh, it's absolutely start investing
Right.
now.
Start investing now to take advantage of that full 100%. Yeah.
Oh, for sure. For sure. Yeah. It's, and who should do it? Who should do a cost seg study? Everybody, guys. If you own commercial real estate, income producing real estate, doesn't matter. You should do it. The concept is it doesn't make sense for you. And that's where we come in. That's where, my team comes in. We refuse to do a full study for somebody, sight unseen kind of scenario. Like, we want to make sure you have every available asset on our side. Like, you've got an analysis in front of you. You've talked to me about it. You've got a strategy for what it's going to look like in the future. You've got a strategy for what it looked like in the past. Everything. Like, we want to make sure that you are full transparency taken care of. And this is kind of one specific example of that. So, active real estate professional, why does that make a difference? If you qualify in the eyes of the IRS as an active real estate professional, that means everything in taxes to you becomes active. Your active gains, active losses, your passive investments, stocks and bonds, just about anything. I mean, anything that was passive is now switched to active. Those are now active losses, active gains. You had a garage sale and you actually told the IRS how much you made from that garage sale. It is now considered active gains. So there's the supply is unlimited when it comes to what you can do with the losses from a cost segregation report if you are an active real estate professional. And how do you qualify to become an active real estate professional? That's something you've got to get with your CPA about, to talk to them. But essentially, you have to meet two qualifications, not either or. You have to meet both of them. 750 hours of real estate services per year, per calendar year, have to be in real estate, whether it's closing, trading, transactions, management, etc., has to be involved in real estate. And more than half of the personal services you performed, or another way of looking at it is maybe 50% or more of the income that you've generated throughout the year is from real estate, closing, trading, um, just cycling, management, everything. If that's real estate related, then you could qualify as an active real estate professional. Or if you are married and you file jointly, if one of you qualifies, then both of you qualify. That's a tidbit I could tell you about later. But don't worry, if you cannot qualify as an active real estate professional, let's say this is your first investment right here. This is your first passive investment, and you have a long way to go to become an active real estate professional. Not a problem, guys. It's actually very beneficial for you, because what you're going to do is you're going to put your investment into this deal, right? This deal that you're working on right now. And if you have a cost segregation report done, you have this ginormous amount of losses that are immediately given to you. So you could quite honestly see this as tax-free investing, because you have enough losses to offset the income you're getting from that investment to set you up. I mean, you're good. And then if there's a refinancing, cash out refi, and you're getting a portion of capital back, hey guys, that's tax-free as well. All of this is tax-free for you. So you've got losses to offset the income. You've got a refi cash out to that's tax-free. You put that money into another investment. Let's say property A goes full cycle, and now when you sell, you have a gains tax you have to pay. Hey, you just invested in a property over here. You can take the losses from that and offset the gains. It becomes $1 million game, and we are winning, and it's wonderful. So when is the best time to do a cost seg study? Okay. Immediately after you acquire the property, you want to get a cost seg done so we can capture everything as it sits based on what you paid for it. When you put in a renovation or improvement a year or two into it, you want us to do a secondary cost seg study so we can capture the improvements you put in, because that's just money added in. If you've already gotten the original acquisition cost segregation study, we've got everything captured, tear everything out, throw it away, because it's already good. It's on paper, it's line itemed out. Then we come in and do just the improvements. That's extra value. That's all going to investors. It's all going to GPs. It's all going to everybody that's involved in the property. On a brand new construction property, you want us to come out and take advantage of the cost seg on it, because one, it gives you a clean depreciation schedule, and it triples the amount of losses that you're acquiring that you can spread to other properties. A look back study, let's say this is the first time you've ever heard of cost segregation. Hey, not a problem. And you've owned a property for 3 years. It's not a problem. We will basically do the cost seg study on it and just account for your straight line depreciation over the last 3 years. That's it. But I'm looking at all this and we're like, there's something missing. Like, we've got, when you acquire it, when it's built, when you've had it for a while, what are we looking at? I'm like, what about when you get a PSA, a signed purchase agreement? Like, why not, that 60-day window kind of scenario? What about during that time? We can do that too. This is the individual depreciation benefit, or IDB. What this does is it is breaking down on a projection level what every investor is putting in, what they will get in tax benefits before putting their money in. So for instance, on this specific example, you have a $10 million purchase tag, take out the land, which leaves you, $8.5 million. It's a syndication. So we're taking, an 80-20 split, a raise amount of $3 million. So with an investment of $100,000, it will break it down to a 3.3% ownership of the LLC, which will get you, with that $100,000 investment, $84,000+ in tax loss year one if you wanted to do bonus depreciation. $84,000. Let's say you, over the course of 5 or 6 years, you want to know how much you're going to make during the full cycle of the property. $100,000 will get 111+ thousand dollars in tax losses. That's over dollar for dollar you're putting in, you're getting back over in tax losses.
Brian, can you
So
repeat that again? Sorry. In what situation would that happen where you get more in
yeah,
depreciation?
I mean, it is all based on the terms of the actual property, the GPs that negotiated the deal. It's an LPGP split. It's the raise amount, the capital raise amount. All of those things play a role, and they partner with the cost segregation projection. All of that plays a role, and it determines the percentage ownership based on the investment. And that's literally how we can break it down. And then I've seen ones like this, $84,000 for bonus depreciation. I've seen some that, they'll say the raise amount was for a $10 million purchase tag was around the $5 or $6 million, which means the year one depreciation would be around 30 or 40,000. So it's all everything plays a role in actually calculating how much percentage of losses every investor gets. But this is something that we want to do to make sure everybody knows what they're getting in. So you can tell them all about the returns, about how amazing the income is going to be on this property, the cash on cash, the projected IRR. Everything is good to go. On my side, I want to make sure that everybody knows how much in tax benefit they're going to get for their investment. Always want to make sure of that. Okay, so quick case study. When I was actually first getting into this, and I was getting really excited about talking to people about it, I met a gentleman in Dallas. He was buying this was his 8th property. He was buying a multifamily property for $28.5 million, and it was his 8th property. Right. And he'd never heard of cost seg before. I explained it to him, and I asked him, what is he getting right now? He's like, well, Brian, I'm, this is my 8th property. I'll probably get over 900K for, per year. And I asked him, is this syndication? He's like, absolutely. So everybody is going to be getting something like maybe 10, 15,000, maybe. And, he's got a lot of money and capital, his own private capital in this as well. So I ran the numbers for him, and he said, I'll give you a shot. Let's go for it. And we did the report, and this is what we came up with. $28.5 million purchase tag. We found that the land was only 10% value. So our basis was $25.65 million. Okay, we took out 65% of the structural components, the 27.5-year property. We found 11% 15-year property and 24% 5-year property, which gave him a bonus depreciation $8.895 million. So 932,727, $8.895 million. I kind of like the million one better. So needless to say, when he looked at this and he double checked with a CPA, he said, hey, Brian, I've got 7 other properties I want you to take a look at. So, the concept is it's not like a sticker shock, guys. This is something that the IRS wants you to do because it's a clean depreciation schedule. It provides, massive amounts of data for their system as well. They want to see, actual assets that are on the property and to see what you're putting into it. I mean, it's something it's kind of like a, what's that? Basically just a study. It's a full case study for them. Okay. So I'm going to do like side effects of cost segregation. Basically, these are things that people have asked me during when I've been doing these presentations for a while. So I always want to make sure and kind of talk to them. So one day maybe I'll have a presentation where there will be no questions, but that will never happen. So is my building too old to benefit from a cost seg report? Absolutely not. It does not matter if your property is just built or if it's 100 years old, right? Once ownership changes, depreciation starts all over again. So you can have this one property that is bought and sold 10 times in 10 years, and you can do 10 different cost seg reports for the different owners. It's all based on when it's bought, who it's bought by. And if it's 100 years old, by the way, you can also take advantage of historical tax credits, but that's another topic. So my CPA does all the depreciation for the property. That's true and false. Okay. Your CPA plugs in the tax loss numbers. All right. They can do, separate line items. They can put everything into the correct life expectancy, but you want to have an engineered base to actually develop the line items associated to each asset. And again, I love CPAs, and I know we got CPAs right there. Hello, um, but you, as an engineer that has that detailed mindset and actually physically visits the property, you will see things that you've never seen just on the online research or whatnot. You're basically getting every amount of detail you can to maximize that depreciation. So the other one is doing cost seg will red flag me for an IRS audit. Yeah, that's not true. Again, the IRS wants you to do this. They want to see a clean depreciation schedule. Now, if you were to say, look, I've got this property, I'm doing cost seg and I'm taking 100% of all the assets or 5-year property, then yeah, they might question that. But you need to get, if you have a reputable company that's doing it and they provide audit protection, then absolutely have it done. You've got to get it done, or at least take a look at it. You cannot leave this money on the table, guys. Oh, and then the dreaded recapture. Ah, so recapture depreciation is essentially, you can, if regardless if you do cost segregation or not, um, at the end of the cycle, if you buy and sell a property, you owe back two things in terms of taxes: the capital gains tax and depreciation recapture. Recapture is essentially, without going into too much detail, it's your cost basis minus the UBIT minus, that's way too much detail or too confusing. You owe back a certain percentage of how much depreciation you've taken, essentially, but it's all based on multiple calculations. I'm going to give you a 10,000 foot example of how this works. So take all the other stuff aside, cost basis, UBITs, minus examples, and we're going to give you this look at it to see why it makes sense to continually do it and see the benefits during ownership. Straight line depreciation example: you buy and sell a property in 5 years. During that 5 years, you took $100,000 of depreciation. Recapture is you owe a maximum payback of 25%, right? So if you took $100,000 and you owed 25% back, that means you owe 25K, which, if you look at it from another angle, during ownership, you really only benefit a $75,000 loss during those 5 years. That's it. Now, take cost segregation, same exact example, except cost segregation usually triples the amount of depreciation during the same amount of time. So 5 years, you took $300,000 of depreciation, which means when you do recapture payback, you pay back 25%, which, yes, you do have to pay 75K back. But during ownership, you free and clear of $225,000 in losses. That's a $150,000 difference. So that's what I want you to look at. I want you to look at the time value of money. It's during ownership. What did you benefit with the most, right? Where did you put that money? Where did you keep that money? Everything during ownership. Now, 5 years later, when you go to sell it, what have you done with that additional savings during the ownership that you can use to offset that sale? That's the key.
Brian, I'm sorry. Can you go back to that slide? So sorry. So is this the same? Like, okay, so you invest 100K in a deal, right? So I'm sorry, why? So why is in the straight line depreciation, why is it 100K and then the bottom is 300K?
Oh, yeah, no, I'm sorry. This
Same
is
amount of time, right? The same amount of time we're talking
yeah.
about.
That's not an investment. That's let's say that's the amount of depreciation that's been taken.
Okay, so like in how much time? Like let's say 3 years?
5 years.
5 years. Okay, 5 years.
It's,
Okay.
I mean, this was just a flat example, just to let everybody know that it's you cannot look at what happens after 5 years. You have to look at what you can do during that 5 years, like
Got
of ownership, and when it goes full cycle,
it.
what you have on the side to actually offset that.
Okay, so during a
Yeah.
5-year period, on a straight line, you would get maybe $100,000 in depreciation versus if you do the cost segregation, it would be $300,000 in depreciation benefit that you would get. And the
Absolutely.
benefit of that, with the recapture tax being, with the recapture tax is that, can you explain that 225K again?
Yeah. So look at it like without looking at the screen, the
Mhm.
numbers to confuse you. Um, when you go to sell a property, if you had cost segregation done, when you sell the property, you will pay back a little bit more in the depreciation recapture taxes,
Right.
but you will have saved more during ownership before you go full cycle.
Okay.
That's what I was trying to really explain on this example.
Okay, got it. Yeah, so you have to pay back recapture using the cost segregation. At the end of 5 years, you have to pay back, like, let's say $300,000, right? Of that recapture. The tax rate on that is 25%.
That's
So
right.
300,000 times 25% is that, out of that $300,000 benefit, you have to pay 75,000 of that for
That's
tax.
right.
So you kind of net 225,000 in benefit at the end of the day.
Exactly.
Okay, got it. Okay,
And
thank you.
because I mean, even if you do straight line depreciation, you still have to pay back depreciation recapture, guys. It's not like something you can avoid unless, of course, you sell it within a year, or I'm sorry, unless you sell it for less than you paid for it, or you die. But we don't want either one of those.
Okay. Yeah, that makes sense. So you're just essentially saying that even with the recapture, the benefit of doing the cost segregation study is a lot greater than doing the straight line way.
Absolutely. There's you just again, it's never leave money on the table. I
Right.
mean, that's the number one thing you want to make sure of. Um, so this
Oh,
is taken from the IRS Cost Segregation Audit Techniques Guide. It's it is a wonderful read. I recommend putting it on your bedside table. It'll put you right out. So essentially, guys, this is just to show you. This is from the IRS. They want a cost seg done. This thing is massive amounts of pages going through all the ins and outs and changing accounting methods and numbering systems and legal analysis. It's got just about everything on there. But for us, this is a checklist. Right? We want to make sure that everything is done according to the standards and um, actual methods of the IRS. Oh yeah, I was gonna say. So here's our basic way of doing things or we used to do things, was when you want us to move forward with a property with doing a cost segregation report, we have engineers on staff that will physically visit your property. They will physically walk around. They will take pictures, physical, like photographic evidence, measurements, detailed line item by line item. They will capture everything and put it into a 80 to 150 page report that's got everything summarized on it that you can hand to your CPA and you're free and clear. They can just put it on K1s. They can, they can distribute it however you want it, but we have everything ready to go for you. So COVID happened and travel restrictions and, people, it was insane. So what we figured out was, the IRS actually allowed us to do a virtual side. So, when you have tenants that are uncomfortable with engineers coming out to the property, or they have to fly somewhere long distance, and the travel arrangements are just done for, we basically figured out a way of doing virtual tours, which is essentially does the exact same thing, except you get your manager on site involved, or yourself involved, basically taking screenshots, doing a FaceTime or a Zoom call or whatever we can do to actually see the property with you virtually. And we will compensate your manager for it, compensate you for it, but we want to make sure we capture everything. We can do it on site, we can do it virtually now. So a lot of people like this. Actually, it's become very beneficial for them to knock out properties really quick. And that is it. I've probably gone way over my time, but
No
sorry.
worries. No worries. Yeah, this is good. We always go over time on our webinars, and people know now to just drop off if they have to leave. But that was great. Thank you.
Absolutely.
So people can get in touch with you.
Oh yeah, yeah. I put my office number, cell phone number. I one thing I love doing. Not only do I do this, but I'm also a passive investor myself in syndications. Um, I just love talking with people that are new to the industry or have been around, for a long time, getting as much information as I can. Or, if somebody's interested more in about a property, they want to know the tax benefits on. I'll do it. I love talking about it, guys. It's fun for me. Plus, again, I'm also a passive investor, so I look for properties as well. I have two main categories. Number one, the property I invest in has to do a cash out refi, and number two, it has to do cost segregation.
Mhm.
I believe in it that strongly that I not only work for, but I also invest, and that's a requirement of mine.
Awesome. Thank you so much, Brian. And I know we have some questions from our audience, and I
Sure.
also have some questions myself, of course. Let's get to Harry's first. Harry had a question going back to that example you gave on that 100, same one that I had a question on as well, the $100,000 depreciation example.
Okay.
Yeah. So if
Oh,
you want to go back to that slide? Yeah, there we go. That one. There we go. So he's asking, so if on the 5th year, someone invests in another project with a first year cost segregation of $100,000, do you still need to pay that $25,000 in that recapture?
Yeah. So if you invest in another property during the same year that you sold this, let's just do property A, property B. This one that you're selling is property A, right? You sold it in 2021. In property B, you invest $100,000 into property B, and the same year, 2021. Now, when you file your 2021 taxes, you will owe the gains tax and the recaptured depreciation for property A that you sold. However, if you take property B and the depreciation you have from property B, you could offset all of those taxes on property A. So that's the key, guys. This whole thing is a tax strategy. So I always recommend, you use the losses as like a dam effect. Have all these losses piling up behind a dam, just like filling up, trickling over on the other side. Only what you need, or what is just offsetting whatever is mandatory, until you're ready to break that dam and just have them all flow out.
Yeah, because those losses, they do roll forward indefinitely, right? There's no expiration for those.
Especially for passive investors. All
All right.
right.
Harry said, that's what I thought. Thanks, Brian.
Oh,
And
you're
I
welcome.
have met in Dallas a couple of months ago. I don't know if you remember Harry from Think Multifamily, but yeah,
Oh,
yes.
hey.
um, and anybody else have any questions? If you do, just go ahead and type them into the chat box, or you can unmute yourself. If not, I have a question. So let me see. Okay, we also have investors, audience members here who invest in single families as well. So you do cost segregation, so you do the cost segregation study for investors in single family and small multifamilies as well?
Oh, yeah, absolutely. So I'll give you what I've done myself personally. I've done as big as a 48-story skyscraper. I've done as small as one half of a duplex.
Mhm.
So literally one unit. So we do single family rental houses, not a problem. I will run an analysis for you. I will say that probably only 50% of the ones that we run are actually beneficial for my clients, but you have to take a look at it. Like,
Mhm.
I don't let it go aside. Don't say, there's no benefit. No, no, no. Let me at least take a look at it first, guys. So I can put it in front of you and show you the numbers.
Okay. Yeah, so if somebody like, has $100,000 to invest, and can you maybe talk a little bit more like, okay, if they take the $100,000 and put it as a down payment for single family property, like, what that kind of depreciation general would look like compared to maybe if they put that, $100,000 into a multifamily, which you kind of cover in this slide, right? You kind of give us an example of what a $100,000 investment and what that depreciation with cost segregation kind of looks like. So kind of compare that to a single family, like what kind of tax benefits and returns would they get?
Yeah.
Um,
So I would fully always recommend investing in multifamily in a syndication if you have the option, which one you would want to do. Um, I don't have anything against single family. I did some single families back in the day, but you know, the returns are far greater. The losses, the depreciation is much greater in multifamily properties because of the amount of actual physical assets on site. With a single family, there's a lot of assets and you can take, the depreciation just like you can multifamily, but it's not going to be near as much as you would get from investing in a syndication.
okay.
The benefits are much greater. They don't outweigh each. I mean, multifamily outweighs single family investment, bar
Mm,
none.
thank you for
Yeah.
clarifying. Okay, and so Lana Choi has a question as well. She says, in your experience of properties that have gone full cycle, how close has the segregation estimates provided during the purchase sale agreement reflect what client actually gets to realize at the end of the cycle?
At the end of the cycle, so it's kind of a
Like a
hit or
5-year investment, yeah, 5-year investment, based on the estimates for the cost segregation. If it goes
oh
to a full 5-year term, how
yeah
much that depreciation do they actually get versus, what was estimated?
yeah. So kind of going a couple different ways on this. So the first thing is whenever we do an estimate, we do a minimum conservative estimate, which means you are guaranteed the amount that we're actually giving you, guaranteed. Lower than that. However, that's a projected analysis. When we visit the property, we I'd probably say 98% of the time we find more than we projected. So it will never be less, but it will always be more. So in terms of the estimate side, you're guaranteed to get at least that amount that we're giving you for the next 5 years. However, um, if I've had some people like we tell them like, look, here's your 5 year, 6 year formula with your estimates and whatnot, but you get an offer you can't refuse in 3 years. So then you go full cycle in 3 years. Then our estimates are they're not 5 years anymore. They're now 3 years. So we're our numbers are always very, very accurate, whether it's per investor or per full property itself. Extremely accurate. I don't think we've ever had gosh I don't think we've had one issue since I've been with the company. So, and that's something else. So one nice thing about I always love talking about previous records and everything. So in the last 20 years my company has been together, we've had a total of 14 clients that have been audited, and it's not because they had cost segregation done. They got audited for other reasons, but the IRS wanted to see their cost segregation report from us. So 14 times we have provided support for all 14, and 14 of 14 had no change. So we have been involved with our clients and not a single change. So because again, we do everything the IRS wants to see in a cost segregation study, and we're proud of it. It's great. I love that record.
And that's why we trust you guys, and we ask you to do that cost segregation study for us every time. So
Perfect.
yeah. And then Lana has one other question. She said, what was the smallest or oddest depreciable asset most people would be surprised to know that you've done?
Well, I've got okay. You know what's fun? I wanted somebody to ask, like, what's the weirdest place you've ever done? I'm like, you don't want to know. Okay, so I'll give you two examples. One's really really cool, and the other one. Okay, so one, security cameras, guys. Security cameras on your property. They are physical assets that are put all around. Right. I think the last 20 multifamilies we've seen, probably 10 times more than that, the security cameras don't work. All right. So they're not plugged in, or they haven't worked in like however many years, but they are physically on site. So we can physically take them as depreciable assets and write them off for you for a 5-year asset mark. So that's all. I mean, because they're physically there, guys. And even the little signs underneath them that say security cameras in use, that's signage that we can take on 15 years. The little details like that, like if you have number plates that are screwed into your doors, like those are all 5-year assets. But if they're painted on, they're 27.5-year assets. So little differences like that too.
That's interesting to know. Next, we'll have to make sure we put those metal signs next time.
We found one last year that just blew me away. Gentlemen, I had my engineer actually call me from the property and say, "Hey, Brian, did you know about the solar panels in this property?" And what solar panels? He's like, "Well, the guy's got 360 carport spaces, and above the carports, each space has a solar panel." And it's like, it's not plugged into anything. It's like, it's just sitting there. It looks like it was put in originally and just never fully installed, and then they sold the property or something, whatever. Anyways, they just from those solar panels, 360 spots, we found them an additional $72,000 in depreciation losses.
Wow.
Yeah. Just little things to find. He had no idea they were there until he actually visited the property and said, "Hey, look what I found."
Nice.
Yeah.
Nice little bonus.
Absolutely.
Well, thank you. I think that's all the questions I see in the chat box.
Yeah.
And you guys feel free to reach out to Brian if you have other questions. That's his contact information right there. Yeah, but thank you so much. So yeah, if you guys really enjoy this presentation and you want to see more presentation like this, or you want to get started in passive investing, I encourage you guys to join this Sage Investor Circle if you are not part of it already. Email us at info@sageinvestinggroup.com to find out more information on how to get started and do passive investing. Thank you so much, Brian. We really appreciate your presentation and your time today. That was super helpful.
My pleasure. My pleasure.
Thank you. All right, bye. Bye, guys. Have a great rest of the day. Thank you so much.
Bye-bye.
Bye-bye.
Thank you and bye. Thanks, Brian.